I don't care what they hold. Listen, I have one product and one service, and that is like, hey, I can give you the best protection out there. You come to me. So you hold Solana, I don't care. You hold Ether, no problem. You hold Bitcoin, no problem. I don't really care what they do. I just want to be the person who is basically a service provider to them, giving them the best hedge that they can get. And that not the person, sorry, the group, the company that does that. And that's what DelphX does.
Hello, everyone, and welcome to episode 82 of Colors of Web3 and Entrepreneurship. My name is Lum, your Web3 host. For those of you who are new to the show, Colors of Web3 and Entrepreneurship is a show highlighting the journeys of builders and innovators in Web3 and entrepreneurship. Some topics, especially in Web3, may get technical, but we do our best to keep it accessible for most viewers. Here today, I'm joined by Patrick Wood. He's the CEO of DelphX Capital Markets. Patrick, could you give a quick introduction by yourself?
Sure. Hi, Lam. Thank you for having me. Yeah, hey, folks, I'm Pat Wood. I'm the president and CEO of a company called DelphX Capital Markets. We're based out of New York and Toronto. We've essentially developed a traditional finance structured product for crypto, specifically around crypto treasuries. So we're offering probably the best quality hedge that crypto treasuries should be and can be deploying. But we'll talk a little bit more about that. But we are a publicly traded company, like I said. Actually, I don't think I mentioned we're a publicly traded company, but we are publicly traded.
Is this in New York or in New York or in Canada?
Actually, so we're actually publicly traded up in Canada and on the OTCQB down here in the States.
Awesome.
But look forward to this conversation.
Yeah, for sure. And then I think many people would be very interested in knowing more about your background. Feel free to pick a point, you think it makes sense to share about your professional background and then walking us forward.
Yeah, I mean, it's pretty basic, actually. I mean, I'm a 30-year finance guy, so worked in capital markets, wore pretty much every hat that you could wear in capital markets. So I started back in the day in the early 90s as a stockbroker. They don't exist anymore, but anyway, I started as a stockbroker, managed a large bond portfolio at one point. I was an institutional salesman, investment banker, and I guess it was about a little bit more than 10 years ago, 2012 kind of thing, after the tech market, or sorry, not the tech market, but after the CDO, CLO, and CDS market collapsed in 2008, decided that it was about time for me to start my own business. So I started a merchant bank and an advisory. And from that, I took a lot of companies public, specifically US companies that were high growth, weren't getting any love in the States. Back then, it was a pretty welcoming environment up in Canada to take these once again, these high growth, awesome companies public in Canada. Some of them were in the blockchain ecosystem. We took a few in various industries public up in Canada, did really well. One of the companies that we took public up in Canada was a company called DelphX. Lo and behold, here I am sitting at the helm of this thing right now. I was supposed to be an interim CEO for a little while, but it's turned into a little bit of a longer gig than that. But like most, or not most, but like a lot of little small companies, they launch, management blows all the money, they totally destroy the company. So I kind of came in and cleaned up the mess. And we've gotten to the point where we assembled great talent. And people who have, really, been heavily involved in capital markets, specifically around credit over the years. And we developed a really cool new product that helps protect against downgrade risks in bonds. And on the back of that, though, we thought about crypto because somebody approached us in the summer and they said, hey, you got this tiny little public company shell. It's totally useless. Why don't you guys, become a treasury? And then we started to look at the treasury space, the Bitcoin treasury or digital asset treasury space. And we thought, oh my gosh, there's so many disconnects here. We noticed immediately that treasuries weren't behaving like proper treasuries. We also noticed that there were a ton of them out there. And, not just that, there weren't any really good sound hedging solutions for those treasuries. So we really adapted our credit product to the treasury space, specifically around Bitcoin hedging. And that's where we find ourselves today. We've been live with our new product, I guess, for about maybe almost 2 months. And right now we're talking with and I can share, we're talking with a lot of treasuries that are looking to move forward with us. and deploy the hedge. So our thinking is that once one treasury starts to behave like a natural treasury, which none of them have been for the last little while, and that's why you've got so many things happening right now that are causing more and more headwinds. But we think this is a great solution because there are other ways to hedge against this type of risk, but ours is the best because ours takes away counterparty risk. It's fully collateralized. There's great transparency in the hedge, and with that, like I said, the smart guys in the room and gals in the room are going to adopt this hedge. Yeah, we couldn't be happier. But to that end, and thinking about Web3, this is the start of something that bringing a traditional finance product to DeFi is kind of like we think we're kind of the leaders in that because no one else has developed structured products yet for the market, or at least none that we've noticed.
Interesting. Yeah. So before we deep dive into all of that, I actually have some other questions like more about like your professional background here, and then yeah, interesting. So you're saying that you took a U.S. company but they went public in Canada. Like why?
Sure.
that's a big question. Why in my head? Yeah.
Sure. Well, back in the day, Canada used to have a really robust market, especially for micro caps, small caps, nano cap companies. And so you had, I think back in the day, 40% of the volume on the TSX, which is the Toronto Stock Exchange, it was international. It was international money. So people from Tokyo, people from Europe, people from all over the place were looking for high growth companies going public that you could find in Canada. So it was a really welcoming environment. Whereas in the States, obviously things are much bigger. You naturally want to be a bigger company before you go public. And the rules stipulate that as well. But, Canada was a good launching pad for a lot of these guys. And a lot of good came out of that. It's no longer like that. Canada blew it up, unfortunately, except in some small minor cases. But, it really did kind of lose that luster. And to be quite frank, it's not necessarily Canada's fault. It's also the fact that the micro cap and nano cap market has lost a lot of investment dollars over the years, which has affected both countries, Canada and the US. It doesn't mean that it's not coming back because right now there's a lot of deals being done in gold and silver, of course, and other things like DATs, Digital Asset Treasuries, except less so now because it's become too much of a crowded field. But it seems to be coming back, which is great. But yeah, back then it was a pretty easy and welcoming, kind of environment. Like I said, it was kind of a springboard for smaller U.S. companies that wanted to grow really fast, attract capital, and be public. So yeah, actually, once again, it was a great time.
Interesting. Yeah. So basically you advising them and then getting them public. And then I think you did mention that you met some of the crypto company, right? In the early days. Is that how you got exposure or
Sure. Good
question. Learn about Web3 in the first place?
Yeah. So funny enough, I wasn't attracted necessarily to crypto. I was attracted to blockchain. So I guess it was in 2013 or so. Probably back. Well, anyway, I can't remember. When you get old, you start forgetting things, especially at 7 a.m. Lem. But yeah. So no, I think it was in 2013. I went to my first Consensus conference, and Consensus was a blockchain crypto conference in New York City. Back then, it was really, really kind of new. It was a very nascent space and industry. But that's how I really kind of came involved with it, or became involved with it. And I thought it was fascinating back then because you had people like the governor of Delaware who was talking about deploying smart contract technology through their government systems, so for like trash collection, maintenance through the city, all that kind of stuff, or through the state. And I thought, oh my gosh, this guy's he's so leading edge. He's leaping into the 20th century. Whereas, most governments and most, states and municipalities, they're still stuck in the dark ages. I thought, wow, this is so cool. And not just that, I met some of the guys in Toronto at the time who created Ethereum through a company called Ledger Labs. And I'm fortunate enough to be associated with one of those people still, who's kind of working with us and being an advisor to us. But yeah, I came to it like that. And then one of the companies we took public was a crypto payments processor based out of Seattle. There were a few other guys too in various industries. And then obviously DelphX was one that was supposedly building a blockchain platform at the time, which they were going to use as kind of a way to displace the current way of dealing with bond sales and bond buys, which is still, over Bloomberg chat or over the phone kind of thing.
I see. Was it building like a public blockchain in the
Well,
past?
these guys were going to do a closed blockchain
Okay.
open to certain people, but
Enterprise.
it's, as I mentioned, the original management group just blew up the company, took all the cash, and left the thing, kind of hung out to dry and didn't accomplish anything. As you know, building a blockchain engine, you have to have the right people doing it. Yeah. It's very tough, and you have to have the right people and capital behind it. And these guys just ran out. So, like I said, we kind of took over a company that really didn't have much, and just built a new company within that ecosystem. And the way we did it was quite frankly, as a team, we brought in some really, really smart people who had experience in the markets before. Specifically, like I said, our original product was a credit market product. So we had some of the best talent in the CLO business, the CDS business, and structured product side come in and work with us. So it was really, really great to get there. But, like any small company, the biggest problem, especially for a company like us, is selling people protection. Nobody wants to buy protection. It's unbelievable until they really need it. But then it's too late. And they're like, oh, man, I should have done that. So for us, our biggest struggle has been, hey, you should be buying some protection. You have a fiduciary duty to buy protection. We have a product which, fits the bill better than most. In fact, better than all of them, I would argue. And anyway, so our kind of MO here is to, kind of open people's eyes, especially in the digital asset treasury side, that they need to be looking at preserving capital, not shooting for alpha and shooting the stars out, because there are a lot of headwinds right now in that space. People who brand themselves as treasuries, we believe, have a fiduciary duty to act as treasurers, not salesmen for their company stock. And with that, like I said, there comes a responsibility that they should be hedging, and really their shareholders should be asking them to diffuse the risk for them. And that's where our hedge really kind of fits the bill. And I'm happy to walk you through how the hedge works, just so you get an idea, and talk about some of the comparables.
Yeah. Make sure. Yeah, I think it's probably the right time. Feel free to let's deep dive. So basically, you took over the company, right? And then as an interim CEO, and then now you've been leading it for how many years now? And then building
a few years.
Okay.
Let's not go through the whole thing. It's a pain point.
Yeah.
But I stuck with it because my shareholders are probably the best shareholders on the planet, and I said, okay, even though I'm starving and this is a tough gig, I kind of felt compelled to do it for them. I promised them a win, so we're going to get a win no matter what.
I see. Yeah, that's quite exciting. I mean, if you're accountable, cool. Yeah. So feel free to share.
So let me talk here. So maybe I kind of start here. So there are a couple of ways to hedge in Bitcoin. And so one of them is OTC options.
Okay.
So you can go into Deribit or a bunch of these other exchanges, and they sell options, and these are over-the-counter options. That's the first way. The second way is, which is very popular. It's actually the biggest volume now, is buying puts and calls on iBit, which is that BlackRock ETF. And so those two products are very, very much designed for the retail investor. And I'll tell you why. OTC options, when things go bad, and actually just look at the last couple of weeks as an example, how people, the options market had bigger volume than the actual underlying. And it was, essentially the derivatives market in Bitcoin especially is driving that market now. So you look at OTC options. If things go bad, who's going to guarantee? So you let's say you bought a put, an OTC option put. Yep. And let's say, the market, Bitcoin drops from what is it right now? Like 100.
It's like 110, something like that. Yeah, something like that.
Yeah, it's 108,442 right now. But let's say it drops to, 90, or let's say even like 50,000. Okay. Let's just assume that in this instance, there's not just one FTX, there's like several. And the thing really gets kicked down badly, which has happened before, by the way, in very recent memory. In 2022 and 2018, both those years saw Bitcoin drop 64 and 74% respectively. Those are massive drops. And that's what makes this important, is that, people should be hedging. And so I'll come back to that in a sec. But if Bitcoin drops to 50,000, What if your counterparty is FTX and you've bought protection through that put?
That'll be really
They're
bad.
not there. Yeah.
Yeah, that'll be
So
really bad.
Yeah. So the OTC, you're not protected. You're done. Yeah. Good luck. You're in bankruptcy court arguing this stuff. Who knows? So once again, that's a danger point but not necessarily for retail investor. Retail investors are hopefully playing with smaller amounts of capital. They're certainly nowhere near in size to some of the larger treasuries out there. So that is a big fallible point, right? On the OTC option side. On the iBit side, you really have a contract that is very retail driven. It's got great liquidity. So if you're a day trader or a punter looking to just, kind of trade on basis points, great way to do it. No problem at all. If things go bad and if counterparties blow up, well, the options clearing corporation steps in and that helps you out. And they do a good job with that. But it is a very kind of standardized market in the sense that you have fixed maturities, you have fixed exercise prices on those options. You certainly, do not have collateral visibility, and unlike our product, you don't have yield on the collateral. So, and I'll come back to that in a sec. So, in essence, there's a big gap there, and the gap between those two products and something that is much better or the best is where we come in and we fill the bill with our product. So I'll kind of walk you through how our product works. You asked me to screen share with you, which is probably a good idea. So
sure.
Give me a quick moment here. I'll just pull it up. So what we've done, and this is something that we've done over the years. It took us, I guess, about several years to kind of get to the point where we're at with this product. And obviously it took us millions in legals to also kind of work through all the things that we needed to as far as, making this an SEC regulated product. And so with that in mind, what we've done is we've taken a traditional finance product and we've adapted it to fill the need in the space. So let me walk you through this. This is a very hypothetical situation. And by the way, when you're looking at hedging Bitcoin as a treasury, you don't really care about the 10% moves because, BTC goes up and down 10%, like on average, three or four times a year. But you are concerned about the 2022 and 2018 moves because those ones really kind of petrify you. You don't want to lose 74% in 1 year or 64% in a year. So in our guide to treasuries, we're saying, look, go 15% below spot or below market. Make that your strike price. Anything below that, you're going to be covered on. So here we go. In this case, you've got an investor who holds 100 million BTC at 114,000. Once again, hypothetical. We all know it's 108,000 today.
Okay.
He's going to go out and he's going to buy what we call a collateralized put obligation. The strike on that collateralized put obligation is 96,900, which is 15% below the market. And it expires, this whole structure, in 12 months. So it's a 1 year protection is what he's doing. In return for that protection, he's going to pay $7 million. And that $7 million goes to somebody on the other side who buys what we call a collateralized reference note. And they take that 96,900, or in this case, 96.9 million. They give it to the custodian in return for the $7 million premium, and the custodian invests that in U.S. Treasuries for 1 year. So you've got a risk buyer and a risk seller. The risk buyer is paying $7 million. The risk seller is saying, I'll take your $7 million and all the way down from 15% below market to zero, I'm going to post collateral of 96.9 million, which is going to sit in the U.S. Treasury for the year. That way, if BTC, really goes down, let's say 50,000, you're fully guaranteed. Your money is there. It's the safest place to have that collateral sit, and it's incredibly transparent. And by virtue of doing this, the treasuries themselves kick off about 4% a year. That 4% goes back to the collateralized reference note holder. So not only does he take the $7 million premium from from what we call a CPO or collateralized put obligation, he's also collecting interest on those treasuries for that 1 year period, which in this case, if you're a hedge fund, you're not going to post 97 million of your own money. you're going to do a thing called the borrow. And your borrow, you're probably going to borrow at 4.5%. But having that 4% come off the treasuries really kind of massages that borrow for you, really kind of helps you out in a big way. iBit options don't do that. OTC options do not do that. So this makes this much more bespoke, much more institutionally driven structure. But you see, Lam, what it does is it takes out counterparty risk, and it also takes out any kind of opacity, in the sense that this is a very, very transparent structure. With US Bank as our custodian in the middle, they manage all the cash flows. We simply act as a broker dealer, which we are, and as placement agent, as well as the issuer of the two new securities. That's our only role in this. After this is issued, once again, both of these are held at US Bank, and like I said, it's the perfect and the best way for any treasury to hedge themselves. What's interesting in this is everybody says to us, like, oh my goodness, 7%, $7 million premium on 114,000. That's a lot of money. How can you do that every year? Well, because of the volatility in Bitcoin, that's why the premium is so high. And once again, you have to pay for that premium, or pay for that volatility. But this works in Bitcoin, and I'll tell you why. Because in Bitcoin, if you believe that the next 10 years are going to be like the last 10 years, where Bitcoin has had a current annual growth rate of 84% a year on kind of, like I said, on a CAGR basis. If you believe that's going to happen, well, you're happy to pay 7% a year to avoid those big market drops, which can sometimes happen. In return for still generating, because if you had gone back 10 years and put this structure on, you would have been up 69% instead of the 84. You're still delivering a wonderful rate of return to your shareholders in your treasury. So this structure really works great in Bitcoin. In fact, it's an amazing structure, because not only are you behaving like a treasury for a change, but you're still delivering awesome results to people. Assuming, once again, your foundation and your thinking is that Bitcoin's going to do the same for the next 10 years as it's done for the last 10 years, which all these guys do. I mean, that's the ethos. Can I stop sharing now? Do you want me to?
Yeah.
Access? Okay.
Yeah, it's good. It's good.
But
Interesting.
yeah, so,
I'm curious. Who are the? I mean, obviously, it would be like not retail product, and who are these intended clients or consumer of this product?
well, sure. Yeah. I mean, the person selling the risk is a hedge fund, and we have a couple of hedge funds already aligned with us. They're willing to do this, and this is what hedge funds do all day. They manage their own risks internally. Funny enough, a lot of treasuries out there have hedge funds that have supported them, given them money. Hedge funds have actually gone out and hedged themselves, but the treasuries haven't. So once again, shareholders are getting smoked, and if things go bad, they're going to get smoked. But yeah, so the hedge fund is the organization selling the protection.
I see.
On the other side, our real focus is treasuries in particular. Although this is versatile. I mean, it could be somebody, starting a new fund, which, funny enough, we're talking with two people right now who are big fund managers who run esoteric type funds, where they're thinking about building a fund around this, a hedged Bitcoin treasury fund, which, once again, that could be very exciting too. But it's really more on the treasuries. And it's for the very fact that treasuries, once again, they have a goal. Certainly they're marketed as being something that requires risk management. And we don't really see that risk management here. It really is kind of take the long view, shoot while it's hot, borrow, and, buy. Well, sure, that does work. But once again, if you're trying to brand yourself as a treasury, and if you want to be a leader in the pack, and attract conservative assets and conservative money, what you really want to be doing is you want to be going out with a message that, hey, come into our treasury. Unfortunately, we're going to burn, 7-8% a year with this hedge, but with a long-term view that, Bitcoin is going to continue with that CAGR of, 84% like it has done over the last 10 years. And we're taking that view, then you're really behaving once again like a treasury. And I think, for the guys who do this, they're really going to differentiate themselves. And if there is a big pullback, then they're going to come out shining. They'll cannibalize everybody else because everyone else will be dead meat, and these guys will be down 15%. That's not a bad place to be.
I see. Yeah, that makes sense. And then, just to make it put it simple for the viewers and listeners over there, right? So, is this true? This product only for hedging the risk of Bitcoin going down, right? So, if Bitcoin goes up, there's no, you're just paying for that premium, and then
you're capturing the upside in this. So Bitcoin, if it goes up 300%, you're still going to be up 300%. That's the thing. There's no cap on the upside.
I see.
Whereas, a retail product with something like this, and it would have a cap on the upside. But no, there's no cap on the upside here. You're just really protecting against the downside. Because that downside is punishing. Like, once again, 2018 down 74%, 2022 down 64%. Those are painful moves, like probably the most painful I've ever seen in the markets over 30 years. So when you have an asset like Bitcoin and a lot of bad actors out there, who are over levered, who perhaps don't have the collateral of certain contractual obligations and things like that, i.e. like the FTXs of the world of the past, if and when those ugly heads get reared, well, then you want to be protected on the downside. So that's our approach to it. And let's face it, it's a real kind of Web 2 type product, but there's malleability to the product in the sense that, as it launches, as it becomes adopted, becomes a norm, then, we have a lot of abilities as a innovative company or an innovator to kind of, move the goalposts a bit and make this more versatile and applicable to other products, specifically in the Web3 space, as that space itself matures and becomes more kind of the norm, which is clearly happening.
I see. Yeah, that makes sense. Yeah. So as I feel like a lot of the Web3 products is eventually going to try to, there's some new innovation coming in the Web3 products. Some of them actually mimicking like some of the structured product coming from traditional finance, right? But some of them also like very new, but of course, like come with a lot of risk as well. So there's a huge volatility in Web3, as you know it. I think Bitcoin is like probably the most volatility resistant if you compare the other.
It is, yeah, no kidding.
Assets out there, right? Yeah. You look at like long tail assets in.
Yeah, I think there's something to be said though about bringing a traditional finance product like this to a Web 2, Web 3 ecosystem, because I believe it actually strengthens the foundation. It brings more, perhaps not integrity, but it brings more credibility to the segment, because when you have risk controls, you're only strengthening the foundation. You're not saying, I don't care about the upside. I'm terrified about the downside. No, you're going into this because you believe the upside is tremendous. But, if you have a view like, hey, I care about my shareholders, my investors, I care about the downside protection, and I'm willing to sacrifice some of that upside to cover that downside. Well, then, then I think, you're going to be beating the pack because no one else is thinking that way. But in essence, it does create a stronger foundation, which, once again, that innovation, that growth can build on. And I think it gives it more credibility. It really does. And it brings in more attention and more money, because right now, 95% of, Web 2 and Web 3 investors aren't invested in Web 2, Web 3 type opportunities. They're sitting on the sidelines. So if you show them something safe or safer, then they're going to be more certainly less reluctant to come into the space and write a check and put their investment dollars behind it. So
yeah, that makes sense. I totally agree. I also seen that a lot of Web 2, maybe traditional finance company, right? They're probably more afraid of a lot of the downside, right? I even heard that even like a 10%.
Yeah,
swing.
You would think so, but a lot of them aren't.
A lot of them aren't.
And a lot of them are really, they're adamant that they don't want to pay for, protection, which, like I said, it's a tough gig for us to convince them to do it. But, it's also one of those things where, once we have a couple of companies doing it, the rest of them will be compelled to do it as well, because they'll be missing out on the marketing that accompanies something like this, which is that, hey, buy our treasury, we're going to cover you from really bad moves, which I think, that can hold a lot of, influence in investors' minds.
Yeah, for sure. And one thing I think we've been seeing a lot in like the even in the public markets now, a lot of these public company buying like digital asset, right? I mean, obviously Bitcoin with Michael Saylor is like the big one, but then also we have Ethereum, Solana, and a bunch of other like crypto token now also being bought. I think like
Sure.
BitTensor, Tau also. Yeah, so I'm
Yeah.
curious, like what is your take on some of those companies? Like, are they? I mean, obviously, I think some of them we know that some of these are not like non-performing company, so their main strategy is like just holding the digital assets, right, and hoping it to go up,
Sure.
and then
Yeah, well, the guys that are doing Ethereum and Solana, I mean, they're looking at staking a lot. That's kind of their agenda. And through staking, they believe they can generate, good enough returns. Look, companies will do what they can to attract money. And like I said at the beginning of the summer, our little nothing stock, because we haven't really marketed or done much on it, until we're actually live, then we really will. But it's a way to quickly make money, right? It's just a hot new flashy thing.
yeah,
I think of all of them, MicroStrategy has probably done the best. They were
yeah.
the first.
I mean,
First
he's
to
a
market
first,
and all the
yeah,
rest. Yeah, but there's a lot of headwinds in that space, right? And the headwinds, they're there in the sense that you've got leverage upon leverage, and the leverage is getting more expensive, so that's a headwind. You also have little shocks here and there, like what happened in the last couple of weeks, which is that's shakes the tree, but it also has the effect of shaking confidence. And there are some other things that are headwinds, and of course you have so many of these darn things now. I think there's like over 200 of them in North America alone that are publicly traded
yeah,
DATs, and so it's no longer kind of a oh wow, this is so unique. What's happened to MicroStrategy now, and you've seen it across the board, is MNAVs, so market value to net asset value, has really compressed. And in a lot of cases, like Metaplanet out of Japan as an example, Metaplanet, their market value is actually less than their net asset value. And there's a variety of reasons for that, namely the fact that Metaplanet has evolved heavily in the derivatives market. And there's not a lot of transparency about the actual derivatives exposure they have, specifically what kind of expirations, what kind of maturities, strike prices, those kinds of things they've got. So once again, you've got a lot of headwinds there. And if you ask me, if I was MicroStrategy, I'd be looking at raising capital right now to actually acquire some of these companies as their MNAVs go below one. And there's a lot of them actually that are trading less than one now. So essentially, you're going to be buying Bitcoin on their balance sheet for less than the price of Bitcoin. And so I think that roll-up structure probably is the right way for these guys to be thinking. But once again, they should be also thinking, hey, let's peel a little off every year just to protect against the downside and strengthen the, not necessarily the balance sheet, but it certainly strengthens the marketing, and it strengthens the integrity of the treasury for sure.
Yeah, I think it's going to be even interesting to see how that space for the digital asset treasury span out as well. Well, coming back to your main product,
there's going to be a lot less of them, not more.
You think so? You think so? Okay.
Oh yeah, for sure. Yeah.
Interesting.
Yeah, 100%.
Why?
Well, because there's just there's too many of them right now, and the headwinds are, like I said earlier, the headwinds are too strong. So when that happens, and when market value has become less than NAV, it no longer becomes compelling to own one of those companies.
I see.
Except in a leveraged buyout, as an example. That makes a lot of sense, and that's where I think the next category of company is going to go. They're going to borrow so that they can buy Bitcoin for less than its net asset value, which is an interesting take on things. So there's a lot of companies out there right now that are trading at like 0.5 MNAV. There's a few on my screen, and I can't believe it. I'm like, wow, okay, why isn't somebody buying these guys? Because if you look at their balance sheet, it's generally quite clean to the point where you're getting a deal. So I would kind of think that's kind of the way it's going to go. I mean, I think Saylor would love for there to be more Bitcoin DATs, more treasuries, because he knows that most of them are going to implode, and that gives him a shooting gallery to essentially buy these things with. Which, like I said, it's a good way to think about things going forward.
Interesting. I mean, the way I kind of think about like Michael Saylor is that I thought that he want more company to buy Bitcoin, and so that it will also like prop up his whole value proposition, right, as like the leader, and then in turn like drive up the value of his company more. But
Sure.
yeah.
I suppose there's some truth to that.
Yeah.
But that, so if you look at the DATs that have come on the market over the last few months, they haven't necessarily supported the price of Bitcoin that much. Or maybe they haven't. There's just so much selling that, they've created a buffer. But I don't think more DATs creates more Bitcoin demand necessarily. There seems to be quite a bit of Bitcoin out there. And right now, the derivative structures and the leverage out there, you don't really know where the supply and demand is. So once again, there are ways to think about it. But if I were him, I'd be looking at having more DATs come out. I would encourage it, because I would know that most of them are going to fail, and I'll be able to scoop them up for 0.5 MNAV down the road. So that's how I think about it. But
okay,
well, yeah, I mean, he's much smarter than I am. But if I were him, I'd be looking at it that way.
Gotcha, makes sense. And then, well, when you release a new product, I think you said it's been out for like 2 months now already. And then I'm curious, like, who do you consider to be like the main competitors for this product that you have?
Well, like I said, I mean, people are acquainted already with OTC options and iBit.
Okay.
Options. And I think those are the two competitors. If you look at, and if you're treasuring, if you're looking for the best, there's no doubt about it that ours is the best, because once again, you're dealing with a product that hits all of the high notes. And if you want to do a hedge, and if you're a larger treasury or fund or big holder of Bitcoin, why do you want to mess with something that's inferior when you could have something that's the best? So we don't really think, and we certainly don't see any competition out there. And let's face it, getting people to use a product like this, not exactly easy stuff. It's not a walk in the park. And to be quite frank, once we get this thing up and running, it's quite likely we'll partner with others to, get them to, kind of take it over, work with us, whatever that might look like. Because at that point, there's going to be a lot of interest in participation, probably from Wall Street dealers.
Nice, exciting. Well, if there's no competition, it's even more winning for your company, right? Obviously, it's like a blue ocean type of place, and
kind of, it's not the competition that worries us. It's more that the struggle is having adoption come into play and getting people to think, like a treasurer of a treasury kind of thing.
Yeah.
And getting them to understand the concept that, hey, with safety could possibly come a lot more investment and a lot more attraction. So
makes sense. Yeah. So I think a lot of like education and marketing, right, need to go in there to get them to understand. And then cool. Yeah, and then for sure. I mean, I'm pretty sure like the speed of the traditional TradFi probably is not as fast as Web3, I would suppose. Yeah.
No, man.
Yeah, some of them moving very slowly. Yeah, exactly. Yeah, but I think also help with like the risk management, right? I guess some of it, because like they're more conservative. Yeah, so they don't like go gamble all in with like regen stuff.
Yeah, I mean, look, it's all about risk management. And selling risk management is the toughest of all sells, right? Because no one wants to pay for protection. And I get that. But, it's like, if you're in the States, as an example, you want to have health insurance. You don't want to go without health insurance. And that health insurance, if you can afford it, you want the best health insurance you can get. And I think that's the way Treasury should be thinking as well. It's like, damn, I don't want to spend the money every month on those darn premiums, or like, let's say car insurance. Any kind of insurance or protection type product, when you start thinking about it like that, we're mandated to do it in our, like I said, in our automobiles, our homes, our health, whatever, our life insurance, those types of things. But why aren't we doing it in our treasuries? It should be something that is almost like, you should feel compelled to actually do it. And you should feel an obligation to do it, to protect your shareholders.
Yeah, for sure. And you said you've been developing this product for like the last several years. So I'm sure you've kind of done a lot of like customer research, right, and then finding out the pain point, and then somehow synthesize and come up with this product, right?
Yeah, but you know what? Transitioning our product to crypto is probably the greatest thing, and because it's happened so fast. And to your point, people who are in the Web 2, Web 3 space, they move really fast. And so, like I said, we've been marketing this product, showing it to people for under 2 months now. And we've made such incredible strides. It's phenomenal. We couldn't be more encouraged. And people get back to us like on the spot. In the credit market world, people get back to you 2 months later type thing. It's like, it's really, really, it's a hard sell. But for us in crypto now, oh my gosh, we're happier than we've ever been. Kind of thing.
Yeah,
so it's
for sure.
Small tweak to the product that has kind of got us to where we are now, which is very exciting. So.
Yeah, I bet. I mean, it's 2 months. I'm not sure if you could share any like traction so far in the last 2 months or not with the product. But
well, yeah, like I said, we have we have a couple of groups who are looking to move forward through their treasury, and so we've got that. We've certainly got 2 fund managers looking at potentially building a new fund around this, and we're in partnership, kind of joint venture talks with 1 or 2 other groups about deploying an NFT strategy to this product, things of that nature going forward. So that's kind of where we're at this stage. But we're at a lot of we're doing a lot of podcasting, a lot of marketing. So the word's coming out, and funny enough, we have inbounds. So people are looking to get more information from us now. Which, if anyone's listening to this, if they want that kind of information, I think they could just go to our website at DelphX.com. So DELPHX.com, and we're all over there.
Nice. Yeah. No, that's really great to hear that there's been so much traction about this for the product in just 2 months. So I'm curious, like, is a business model you take a fee on this, right, for every sale? Is that right?
Yeah. So for each transaction we do, our costs, so our custodial costs are around $20,000. So our minimum fee is $50,000 for the buyer of the protection and the seller of the protection, or we take a percentage of the premium. So you remember that 7 million that I showed you in the example? We'll take 5% of that, 150,000, which is kind of a standard fee. And out of that, like I said, we pay 25 to overhead, which is custodial costs. The rest sit on our bottom line. So our margins are very, very respectable. Kind of the lowest our margins would be 70%. So, which is nice.
Yeah, which is really good for sure. Cool. So it sounds like, I mean, everything is going well. Product is launching, but I'm curious. There's always some sort of a challenge, and then problems facing it. Right? Any particular problem facing your company?
Yeah, of course. Yeah. Well, I mean, our company right now, we have a market cap of like next to nothing. So that's never a good thing, because we just, until we have things going, we're not going to spend on marketing, et cetera, quite yet. But But the other thing is, of course, if you look at the last couple of weeks, I mean, Bitcoin a couple of weeks ago was 125, or it was even kind of 126, 128. Now it's down at 108. So the market's already started to move. So we were right. Yeah. People should have been buying this protection, but yeah, so the market's moved. And so now it's like, okay, there's a bit of trepidation from the people we're talking with about putting on the hedge. They're like, oh man, well, we'll wait for it to go back up to 125, 130, and then we'll do it then. That's the wrong way to think, but hey, listen, we're going to play ball with that, obviously. And so I think there's a bit of that going on. And that's a bit of a worry for us because that delays us kind of launching. But I think, really the smart treasury that comes to us and says, we're ready to do this, now, I mean, you can't really pick those points in time where it's the right or wrong point to do it. No one can really do that. But I would think just some delays, as always, are kind of our fear. But, we have, like I said, the world's greatest shareholders supporting us, keeping the company alive. So paying for, our public listing fees, auditing, all these other kinds of things that you have to do, legal fees, of course. But, yeah, I mean, I think, the worst problem for us is just timing a bit, and we can't control that. It's one of the things that's just kind of out there. But yeah, that's kind of our fear. I mean, the other fear is, maybe getting run over by a bus while I'm walking my dog later or something like that. But yeah, those are not company specific.
I see.
Yeah, those are just normal guy problems. But that's kind of the land. That's kind of what we're thinking.
Gotcha.
We can't control the timing always.
Yeah, for sure. I mean, there's probably some timing procedure going on. Anyway, I think you did mention Bitcoin. I think I believe that the crash 125 to down to 110. That was probably this is just a lot of I was reading stuff into this. I think some of it's affected by the Trump tariff, but also maybe with the over leverage futures market in the crypto as well too. I think that also got it affected, and then that was it was all huge crash.
Yeah, it had
over leverage.
President Trump. Yeah, no, President Trump made a comment about tariffs, which I think kicked it off. But, these, the algorithms that everyone's trading with and the programs, they all just kicked into overdrive. And then you had a rush to the exits. And then you had exchanges basically blowing out positions in altcoins and other things.
Yeah.
So you really did have a cataclysmic effect in that market in a very, very short amount of time. And that's what makes some of these exchanges very nervous to me, because these exchanges aren't like normal exchanges. They don't have, circuit breakers and things like that, which once again, is another reason why if you're a treasury, you've got to be hedged. I mean, if you're not, you're out of your mind, because you can't believe in the integrity of a system that's clearly broken. And it breaks at certain times. It's not, a normal exchange. It's too high velocity, too leverage driven, too opaque at a bunch of different levels.
I think there's one of the biggest crash in like crypto. I think with like $20 billion in leverage,
Sure.
like getting liquidated.
Yeah, it was all leverage though.
In just one day.
Leverage, man. Yeah. I mean, the underlying,
crazy.
I mean, let's face it, the underlying asset, whatever you want to call Bitcoin, the underlying asset is what I like to call it. There's no problems with that. It's actually fine. But when you have, such an unregulated market like this, which is so high velocity on the leverage side, like 50-to-1 type stuff, you're going to have massive blowouts at certain times. This one was contained, but who knows if the next one's not. And the problem though is when these things blow up, and this is what's very important, is when they blow up, and if they don't, and if they continue to drip down, and if there's loss of confidence, well, if there are any bad actors out there, they get exposed pretty quickly. So that's when the bad stuff comes out. And if the bad stuff comes out and people find out there are bad actors out there, or people, groups that are way over leveraged, etc., that's when you have a cataclysmic effect, and then you have Bitcoin at 50,000, and that could happen like that. So I think, again, people should be thinking like, hey, what happened a couple of years ago? What happened a couple of years before that? They really should acknowledge that, because if they don't, then they're running blind. So
yeah, for sure. I don't think there's a lot of enough like risk management yet in like Web3 space, especially with people like over leverage. And also like Black Swan is probably like a very foreign concept, but I think we have seen, right, a lot of Black Swan event happening with FTX blow up and then funds, and now like with the 1010 that happened 2 weeks ago.
Yeah, and listen, I can't name names, but I would suspect that there are a lot of those out there right now. I don't think there's just one FTX out there. I would suspect there would be several. Certainly companies that might not be frauds like FTX, but companies which could be way over levered, such that, they have counterparties that are relying on them being solvent, but perhaps they're not. And if things go bad, they're definitely not going to be solvent. So that's the big headwind. And that's what, that's once again why you hedge. Put on some protection.
Yeah, it's like a time bomb. We don't know when it explode, but it will probably explode at some point.
I mean, seriously, I don't know why people don't do it, but we're getting there, and they will, which will be great.
Crazy. Cool. Yeah, just a couple more questions before we close out the show.
Sure, man.
I'm curious, like, so what? Since you're all talking about a lot of the new product, like, so what should a Web2 smart finance treasury company hold? Should they diversify and then like maybe I don't know, give some of your opinion on that?
Jeez.
Obviously they should hedge.
Yeah, I mean, obviously hedge. Yeah, I mean, I don't care what they hold. Listen, I have one product and one service, and that is like, hey, I can give you the best protection out there. Come to me. So you hold Solana, I don't care. You hold Ether, no problem. You hold Bitcoin, no problem. I don't really care what they do. I just want to be the person who is basically a service provider to them, giving them the best hedge that they can get. And that not the person, sorry, the group, the company that does that. And that's what DelphX does.
Yeah. Okay. Cool. And then I think a lot of the entrepreneurs would be very interested in knowing about, like, do you have any advice for people to, like, well, this is like a very special niche, I guess, but how did you turn around, a company that was like failing and now into like very successful and growing company? Like, can you share some advice here?
Yeah. So, I'm only 20 years old, but this is what happens when you do this. I'm kidding.
I know,
no, man. It's don't do it. Don't. No, absolutely not. No, there were a million other things I could have done rather than do this. And but changing a company around, developing a product that no one really, wants, or that, takes so long to kind of get to market, like our credit product was, that kind of stuff, it's a tough journey, and there's a lot of things too, like cleaning the decks of the company, all that kind of stuff. I would never I would never recommend anyone come in and try to repair a company. If you're an entrepreneur, I would highly recommend being an entrepreneur, though, too. I think you read a book called The 22 Immutable Laws of Marketing. You start there. And it's a book, once again, called The 22 Immutable Laws of Marketing. Think about that, because that's where you develop a new product, but you're not basically creating a whole new product. You're taking an existing product, making it better. You're thinking outside the box. You're doing things that are different and better. And so, listen, being a small business person and an entrepreneur, go for it, 100%. I think the world needs more innovation, because the big companies aren't innovating stuff anymore. They're just kind of, sitting there like fat cats dominating the space. But innovation needs to come back certainly to finance and the structured product space, and certainly to crypto. Like, it definitely, there's a lot of room to develop new solutions for those markets, because they are somewhat nascent in the sense that they're still being adopted by people. So I think there's a lot of room to, like I said, innovate, build, and make better.
Interesting. Yeah, thank you for sharing that. So
kind of a wishy-washy answer.
Yeah, no, all good. No, I think it's great. Yeah, I think you have a great book recommendation. Yeah, that we're gonna put in there. And then how do you think the structured finance product space will evolve in the future? Then, just follow up on that.
I don't know, man. I mean, we just hope that we can continue to develop solutions for the space, be it crypto or credit markets. That's kind of our goal, is to keep developing new products and filling new gaps and doing it really smart. And once again, just basically doing what Wall Street used to do. But because they're not innovating things anymore, we get to step in, and there's a little bit of a space here for us to kind of do cool things. So
makes sense. Yeah, someone got to fill in the gaps, right, of the innovation. Someone got to develop the painkillers, right? You can't just like just building the vitamins. Yeah. Someone have to build the painkiller.
Yeah, no, you don't want to sell vitamins. You want to sell painkillers always.
Yeah, exactly.
And that's clearly our ethos on this. So
awesome. And then final question: where can people follow you and your company? Feel free to share any public handle.
Just go to our website. Once again, it's DELPHX.com, and then we're on X. We're at DELPH capital X _, and people can follow us there. I think we're on LinkedIn and stuff like that too. I don't run any of the social media. We have a person, actually a small group, that helps us with that stuff. But it's pretty well curated. All of our content's there, and just keep an eye out for us on podcasts and other things. And of course, check out our press releases as they kind of come out over the next little while. We'll probably be announcing some pretty exciting stuff.
Nice. Yeah. So I'll make sure to put all the links here down in the show notes, so that for the people and watcher to follow them along. Yeah, for the X and LinkedIn to follow along. Yeah. Once again, Patrick, it's been a real pleasure having you on the show today, talking about your new product. I think, and then how the structured product finance space will evolve. And thanks for your entrepreneurship lesson as well too. So
thank you, Lam.
It's been a real pleasure.
Thanks, mate.
Thank you.
Have a good one. Cheers. Bye.
And we're back to my studio. What do you think about the structured finance product that Patrick and his company, DelphX Capital Markets, are offering? Will it be a game changer? Will it help to bring more investors into Web3? Feel free to leave your comments down below. For the next episode, we'll be talking to Dan Rodman. He's the CEO of CoUnity. CoUnity designs and scales thriving Web3 communities by blending tailored strategies with cutting-edge tools. They handle everything from advisory to execution, and their service is trusted by many industry leaders in Web3. If you enjoyed this episode about Web3 and entrepreneurship, please, it will help us a lot to give us a like and subscribe. Thank you for watching, and see you next time.